The final session of the conference is on capital supervision of large U.S. financial institutions, and a very timely article in today's Wall Street Journal. It announced the results of the stress tests on Fannie Mae and Freddie Mac. These were results apparently announced yesterday and reported in the paper today. So I've put up the Wall Street Journal page, and it's certainly relevant for the first paper, which Kris Gerardi will be presenting on the failure of supervisory stress testing done by FAO.
All right, thanks a lot. I want to thank the conference organizers for inviting us to give this paper at the conference. It's been so far an awesome conference. I feel like I've actually learned a lot. So yeah, I'm going to be presenting joint work with Scott Frame, who's also at FRB Atlanta, and Paul Willen, who, as most of you know, is in the audience. Okay, so this is a paper about, I sort of think about it as a case study or forensic analysis of sort of what can and did go wrong in a sort of interesting case of stress testing that took place before the financial crisis. So just not that I have to motivate this topic too much for people in this room, but indulge me for a second. Since the crisis, many economists, policymakers especially, have taken the perspective that stress tests are a pretty potent macroprudential tool to prevent future financial crises. And that had we done stress tests in the pre-crisis period, maybe we would have had different outcomes. The Federal Reserve, of course, has made stress testing kind of one of a key part of maintaining of its financial stability mandate. Again, most of you know what a stress test is, but for those of you who don't, it's pretty basic. You propose a bad scenario, macroeconomic scenario, GDP, unemployment, and then you ask how a portfolio of assets will perform, and you then tie capital requirements to that performance. Now, before the crisis, so there's lots of examples of stress testing after the crisis. Before the crisis, there was a government agency that did this, and it was the Office of Federal Housing Enterprise Oversight, the regulator of Fannie Mae and Freddie Mac. And they actually did it throughout much of the 2000s on a quarterly basis. They would stress test Fannie Mae and Freddie Mac. And the appropriate question, how do they do? Well, most of you can forecast this slide, right? So this is just a rough comparison to the money that went through TARP, to the money that the government shelled out in TARP to bail out the banks versus the money that they shelled out to bail out Fannie Mae and Freddie Mac. And you can see, we can quibble a little bit with these numbers, but the basic the basic takeaway is there's about an order of magnitude difference here. So some pushback that I've gotten in presenting this paper in the past is that, well, there really was no way that a stress test could have worked in the pre-crisis period. Part of the issue, there's this sort of belief out there that it was very difficult. We didn't have the right models or the appropriate modeling technology to forecast mortgage performance in a really severe downturn. And there's lots of excuses that people will give. But with lack of available data on house price declines, et cetera. But I think the evidence, at least the evidence that my co-authors and I have tried to have aggregated, suggests that there were some pretty good models out there. There were certainly models at big banks and even at credit rating agencies that actually got that got pretty close to that were able to forecast, given the right scenario, given a dramatic decline in house prices, would have actually spit out something that looked reasonable in terms of losses, at least in terms of how they stacked up in reality. And just to give you an example, I took this from a previous paper, and this is the paper that Bill had kindly mentioned in his introductory remarks yesterday afternoon. We took this from an analyst report that was published by Lehman Brothers in August of 2005, and it sort of lays out a distribution of house price scenarios. And for each scenario, there's 5 scenarios. For each scenario, it calculates, it estimates, they use their models to estimate the losses that they would they would experience on the mortgages, on mortgage-backed securities. And actually, you can see that under their meltdown scenario, which is still less of a meltdown than what actually happened, but it's the closest of any of these scenarios, you can see that the forecasted losses for 2006 ABX was about a quarter, about 23%. That was the actual loss, and their forecast was about 17%. And of course, it turns out that the meltdown was actually a little bit, the actual house price drop was a little bit more severe than they had thought. So the point is, these numbers don't match up exactly, but they're not that far off. And of course, the problem was that they put such a low probability on this meltdown scenario. And this was one of a number of reports that we had aggregated for this paper. And then, just as an example of a stress test that we might argue actually worked, if you look at the rating agencies and you look at how they did in terms of impairments for AAA rated RMBS, you can see, so this is the blue line. So I'm showing you the 2006 and the 2007 vintages. And the blue line, the bottom blue line, are impairments on the AAAs, about 10%. And given the fact that it was an unprecedented collapse in house prices and a really, really, really severe recession, they held up pretty good. Now, of course, the CDOs were a different story. For that, you can talk to Larry Cordell. He's the CDO expert there, I guess. Okay, so Fannie and Freddie, what do they do first? They engage in 2 risky activities. They had a retained portfolio that consisted of MBS and derivatives. We're going to ignore that in this paper. This was part of the stress test that FAO did, but it's not something that we have data on, and it was a relatively minor component compared to what we are going to focus on, which is the credit guarantee business. So this is where they guarantee the credit on mortgages and then sell the MBS to investors. So we're going to focus on the guarantee book and specifically on 30-year fixed rate mortgages. And so where did the stress test derive from? Well, it derived from the GSE Act in 1992, and that act established basically 2 levels of capital for the GSEs. There was the minimum capital requirement, which was set in the statute, 2.5% of portfolio assets, and then 45 basis points for mortgages that they guaranteed, which is what we're going to focus on in this paper. And then, and just to give you a rough idea, in 2006, Fannie Mae guaranteed about almost $3 trillion worth of mortgages. The minimum capital requirement would have said they had to hold $12 billion. And if 1% of the mortgages defaulted, then, and we assume a recovery rate of 2/3, they'd lose about $9 billion, just to give you an idea of the rough magnitudes. The second part the second capital requirement was called the risk-based capital requirement. And this was what was set by the outcome of the stress test. And the function was basically the minimum. So whatever the maximum. So whatever number came out of the risk-based capital requirement, if it was higher than the minimum capital requirement, that would be the binding requirement set for the GSE. If it was lower, then it was just the minimum. Okay, and the stress test, which I'll go through now, basically said each firm must maintain positive capital throughout a 10-year period of stressful credit and interest rate conditions. Okay, so there were 2 components of the stress scenario. There were interest rates. They had a separate scenario. There was a down rate scenario, and then there was an up rate scenario. And for both of those scenarios, there was then the same house price scenario. And the house price scenario, which we're going to focus on in this paper, was tied to it was based on the path of the West-South Central AFEO HPI from 1985 to 1994. And I graphed it here, and I basically just, well, for purposes that you'll see later, I basically just set it, I calculated it so that it begins in 2006, and I just used the growth rates to show you. Later, I'm going to compare it to what actually happened in the crisis. So, and this was selected on what they call the benchmark loss experience, which was the performance of mortgages originated in 83 and 84 in Arkansas, Louisiana, Mississippi, and Oklahoma, which fared pretty badly. Okay, so the model, which we're going to replicate in this paper, is we're going to focus on 30-year fixed-rate mortgages, mostly because it's pretty simple, and it comprised about 75% of the business. It was a pretty simple model. It was a form of a hazard model, so similar to what many papers here have been estimating over the past couple days. They basically jointly modeled default and prepayment, and these were the main covariates. Pretty simple: loan age, LTV. They updated, so they had mark-to-market LTVs that were updated based on the housing price scenario. Some information about the refi, whether the refi option was in or out of the money. It was missing a lot of things, but this model was basically developed in the late 90s, actually mid to late 90s. So it was missing credit scores. It was missing, regional variables like unemployment. It was missing lots of loan characteristics and borrower characteristics that most modelers would incorporate into their models now. But these were the core variables. The model was frozen in 1999, so the parameters were never updated throughout the whole stress testing period. Okay, so they used a model to forecast the credit and prepayment risk, and then to calculate capital requirements, they basically forecasted cash flows. So it was pretty straightforward. I don't really have too much time to go through this. It's all in the paper, but basically you just make assumptions about your revenue and about losses given default, and then you forecast cash flows, and then you discount to a present value, and voila, you get an estimate of forecasted losses, which you then tie to capital. And to give you an idea of the timeline, here's the timeline. 1992 was the act. The final rule was announced in 2001. There was a pretty infamous paper that was co-authored by Joe Stiglitz that basically said, look, if they can pass the stress test, their insolvency risk is basically zero. Stress test became effective in Q4 2002, and of course in September 2008, the Treasury put Fannie Mae and Freddie Mac into conservatorship. So just to give you an idea, this was the capital that came out of the stress test, the capital requirement, RBC minimum, and you can see the black line. This is for Freddie Mac. The black line is the minimum that was set in statute. This is the 2.5% plus 45 basis points for the credit guarantees. And you can see that even in 2008, the RBC capital number never breached the minimum. So what do we do in this paper? I don't have too much time to go through the details, but we basically reverse engineered the stress test. So we estimated a model using basically the AFEO model, using data on GSE mortgages, and then asked the question, why did the test say that they could withstand a stressful scenario when they were basically already insolvent? And so this is basically what we find when we reverse engineered the test. Using AFEO's model, all the details of the model are publicly available. And then using a random sample of GSE loans, which I'll describe a little bit later in a few slides. This is what the stress test, this is our replication of the stress test. We're going to compare it to the 45 basis points, which was the minimum required capital for their credit guarantees. And basically what you can see is that the stress test wouldn't breach that minimum until well into 2008, until about the fall of 2008. So basically our conclusion is the stress test failed, and I guess that's kind of obvious considering that the Treasury had to bail them out to the tune of $200+ billion. Okay, so what do we find? Because I'm gonna run out of time. Well, we investigated sort of, as I said, it's sort of a forensic analysis to try to figure out, well, what happened? What went wrong? Why did the stress test, why was it saying that even in 2008, in the summer of 2008, second quarter, third quarter, that Fannie Mae and Freddie Mac could survive with, basically 20 basis points of capital, when essentially they were, by all other measures, they were already pretty much insolvent. And we found three issues. Number one was the stress scenario they used. Number two was the model, the fact that they didn't update the model at all, either the parameters for the variables, the variables that they use, or the addition of new variables that research had found to be correlated with credit risk in the mortgage space. And then finally, there was an assumption about no new business. So the way they conducted the stress test was they only stress tested the GSE's portfolio, and they assumed that the GSEs would originate no mortgages in the future. Okay, so the data, real quick, we get from LPS. We can identify GSE loans, and we use a random sample. The details are in the paper. We were fortunate enough to get some rough summary statistics from FHFA, and we're pretty confident. We do this little comparison. We're pretty confident that we have a representative sample of Fannie and Freddie mortgages. Okay, so the first issue was the stress scenario. The red dotted line is the scenario that FAO used. And what's interesting is there are sort of two issues. Number one, the peak to trough decline was not close to what happened in reality. So this black line is the actual trajectory of house prices at the national level during the crisis. But the more interesting issue was the fact that the first 10 quarters, the scenario assumed flat to slightly positive house price increases. And that turned out to be a big issue. So when we maintain the same model, but basically use the actual path of prices that prevailed in the crisis, you can see that this line just shifts a little bit upward. And so basically, with the actual scenario, if they had 2020, with 2020 hindsight, they would have the GSEs would have breached this minimum capital requirement about a year earlier than what the stress test with their scenario said. Okay, we then look at the model. So this blue line is just a quarterly forecast of mortgage defaults. The black line is the actual is the actual data, and the blue line is the forecast that came from the FAO model that was never updated with a limited set of covariates. And you can see that basically it predicts pretty flat default rates, and then you get this slight bump up beginning in 2007. But you can see that the forecast error is just huge. It just blows out starting in 2007. So we did a few things. We updated the model parameters. That was one thing. So we kept the model the same. The only thing we did was update the parameters. You can see that certainly improves the mean squared errors here in the forecast. And then we actually added a bunch of covariates like credit scores. We tried to make the model as similar to what you would see, in academia and industry. So, lots of characteristics and interactions and things like that. And you can see there are big improvements. How do those get translated to the capital calculation? Well, you can see now that you get about 2 years. So basically, the model then now says that the stress is too high about 2 years before conservatorship. So to wrap up, the third issue, and this is something that we need to do a little bit more work on, I think, but there's still something, if you stare at this picture long enough, there's a puzzle here. And the puzzle is that even with what we think of as a better model and the actual scenario from the financial crisis, the model still says that basically if we had moved the financial crisis 2 years ahead. So if the financial crisis had happened in, say, 2005, that the GSEs would have been able to withstand the crisis with zero capital. That's what this chart says. And that was a little puzzle. That should be a little puzzling. And in the paper, there's a pretty lengthy discussion, but it's a little bit speculative because we haven't done any empirical exercises yet. But there are sort of two reasonable explanations, we think. One is that the loans in 2006 and 7 were just okay. Sorry, I'll wrap it up right now. The loans in 2006 and 2007 were just underwritten with much looser underwriting standards. In other words, the loans were just becoming riskier. They were purchasing riskier and riskier loans. Or there's the no new business assumption, which is basic, and we think that it's the latter. So we have some statistics in the paper that show, look, underwriting did deteriorate for the GSEs. They were purchasing riskier loans, but not that much riskier on many dimensions. What really sunk the stress test was the fact that if you look at the distribution of losses by vintage in the crisis, most of their losses came from the 2006 and 2007 vintage loans. And a stress test in 2005 assumed that those loans would never exist. And that was probably the issue. So they did actually think about this, but concluded that it wasn't an important issue. All right, thank you.
Thank you, Kris. The discussant is Hughes from the Board of Governors. Whoops, sorry. I jumped ahead. It's John.
Down if you have some words.
You confused me by moving up here. How did we get rid of that?
All right, great. Thanks a lot to the organizers, Jalapa, everyone from Philadelphia. This has been a great conference. Happy to be here. Okay, nice paper as usual from these guys. We get something that's very ambitious. Most of the papers that we've seen at this conference, and really most of the papers that we see anywhere on this topic, tend to focus on PD modeling, right? I mean, this is a well-defined statistical problem, and we feel like we know how to do that, and there's just an awful lot of work on that. Kris and co-authors basically do the whole stress test here, basically. Which is commendable. I guess before I get into my main comments, though, I would like to say that in future work, it'd be very nice to exploit that all these pieces you have lying around. I mean, for those of us who work on stress testing, we always sort of wonder, where is the bottom line most sensitive to? Is it to the PD model or the LGD model, the balance projections? Kris was talking a little bit about that at the end of his presentation. But I mean, are we vulnerable to situations where we're making errors in exactly the same direction for all of these model components? And since we're sort of multiplying them all together to get an expected loss, the amplification of these errors can be big. So I mean, that might be a really useful thing to look at in the future. But the main ideas that are in this paper are certainly useful enough. I mean, we have this nice reminder that stress testing did not begin with the first stress test that the Federal Reserve was involved in 2009. That was really kind of an aberration. That this is a stress test that took place in the midst of a financial crisis. What we do now is much more like the Orfeo stress test, and clearly there's a lot to learn from what went wrong with Orfeo that arguably did fail. And this is such a nice example to work with because Orfeo was very transparent about what that model, what the model structure was. So these guys could go in and replicate the results and then gradually change things and see how much better you could do. So the main results, Kris got through them in his presentation. My main takeaways are basically the same, but I'm going to chip away at some of his conclusions. But we have this idea that it's a good idea to update your model coefficients. We should do that. Watch out for compositional changes in the portfolio that might want you to change your specification, the big one in my mind is, well, here's some more evidence that people made large house price forecasting errors. I'm going to run out of time eventually, but the lessons that I'm going to draw from this paper are these first 2 points about updating coefficients and changing specifications. This is going to be easier said than done. Doing this in real time and limiting model risk is going to be hard. So I would argue that this paper is really telling us that we just need to focus very much on scenario design to make sure that we're limiting our the possible errors our stress tests are giving us. Okay, so what are these problems? So we have model risk. So coefficients can drift, specifications can drift and no longer be useful. We have the scenario design risk, and then at the end of the day, we have this implementation risk. What are we going to do with the stress test results? And my guess is that if Orfeo knew just how inadequate their model was, they probably would have had different controls in place. They probably would have asked for more capital to be in place. So given that we know that we don't know certain things, parameters about how the economy works, we should think about how we're actually going to harness the stress testing results. Okay, so updating model coefficients. This is really the big wow part of the paper. So if you simply take the old model and rerun it and get some updated data in there, the coefficients will change and you'll get a 2-quarter advance warning on the insolvency. And this really does seem like so call that an unforced error there. But that does beg the question: how often should we be updating our coefficients? For a lot of models across these risk stripes, we don't have very long time series. So if you're updating a lot at a high frequency, you're actually going to inject some cyclicality into these coefficients before the models stabilize, steady out. At the low frequency, that's clearly not good. Orfeo kind of showed us that. But do we use stress period coefficients? Is there some way that we can test and get a sense of how often we should be doing this? My own sense is that this is how often you re-estimate or recalibrate is going to depend a lot on how well these models tend to fit in samples. So this is a relative statement. So my sense is that default is relatively easier to model. And so there's a caveat that we have this sort of catastrophic error in default forecasting. But compared to prepayment, I think default is we sort of know more about what the causal variables are. So in that case, we probably do want to update our models. More data is better. For prepayment, that's probably not the case. There's all this idiosyncratic behavior that's hard to observe, hard to manage. So I think we can actually take a cue from private sector vendors, like for prepayment modelers, like the ADCO model or BlackRock. My understanding is that these models aren't re-estimated very frequently, but they're frequently tuned and given a lot of overlays. So I mean, this is a very kind of thought-provoking observation that you get. Yeah, we should update, but how much? On the model specification, this as Kris was saying, this is potentially where the real benefits can be realized. But there's a little bit of a peek ahead bias that I said look back bias. I guess that's my West Coast jet lag kicking in. But in 2015, we know that there are some models that were well, in 2015, we know that there were models that were there were variables that would have been very useful. Oh yeah, I guess it's just my screen that went out. There were these variables that would be very useful to have, but in 2005, would you have known to put these models in your specification? So I mean, if I were to think about how we would handle this problem, if we were cast back doing CCAR in 2005, I'm not sure that we would have realized all the gains that Kris was outlining there, that we would have had a really good model that would have given us this 2-year advanced warning. So there are a lot of model governance issues that tend to slow down the whole updating process. Okay. So there's operational risk. If somebody suddenly told you had to get a low documentation variable in your model, we can get it in the model, but we need to ask the banks for that, and that's going to take forever to get them to do that right, do that consistently. So at any rate, I guess to wrap up, I'm a little pessimistic that we would be able to sort of match what you were able to do. So I mean, that's not to dispute your findings at all, but in my mind it does sort of push the question to we need to be very careful about getting good scenarios and probably putting some probabilities on this. Okay, thanks. Sorry to go over.
Okay. The second paper is by Bev Hirtle, Bank Holding Company Dividends and Repurchases During the Financial Crisis.
They seem to attract technological problems like glue here, everywhere I go.
Okay.
There we go.
This is back and forth. This is a laser pointer.
Okay, all right, thank you. Like all the other speakers, I would like to thank the conference organizers for inviting me to give this paper today, which has almost nothing to do or absolutely nothing to do with consumer credit, but does have something to do with capital at large bank companies. So I have to give the disclaimer that these are my views and not the New York Fed's views. What I'm going to talk about today is a quick look at dividends and repurchases done by bank holding companies during the financial crisis, looking at the question of why didn't banks cut their dividends quicker than they did. We're going to talk about some theories that have been advanced for why banks behaved the way they did in terms of dividends during the crisis, and then ask a question about what role did repurchases play in those decisions. So this is a chart that many people are in some sense familiar with. It shows dividend payments by large bank holding companies. And the fact that everybody points to is that as we moved into the financial crisis, although dividends began to decline in 2008, it really wasn't until 2009 and into 2009 to dividends reached all the way down to the approximately zero that they eventually hit. The fact that banks continued to pay dividends in the teeth of the crisis was noted by commentators at the time. David Sharfstein and Jeremy Stein had a Wall Street Journal op-ed on this in 2008, and there have been academic papers talking about this phenomena since. I think there are sort of two potential explanations that have been out there. One is a kind of risk-shifting explanation that by not cutting dividends and sort of doubling down on increasing leverage, bank holding companies shifted risk to their creditors and to other banks. An alternative explanation, and the one that I'm going to pursue a little bit in this paper, is a signaling story. There's a long literature on the negative market impact of cutting dividends, and that banks did not want to, to send that negative signal into the market during the crisis, which is a period of very high uncertainty. So, to make the story a little bit richer, we're going to pay attention to share repurchases, which had a very different pattern during the financial crisis. So this is the same chart as before, only the red lines now are an estimate of share repurchases by these same bank holding companies. So there's a few things I want to point out. The first is in the pre-crisis period. This is 2005 and 2006, but you could look further back. That repurchases were as big, if not bigger than dividends. They were more variable than dividends. That's kind of the standardized result for repurchases. But they were just as important in terms of returning capital to shareholders as dividends. But unlike dividends, this is 2007. As the crisis began, repurchases began to fall sharply and quickly. And by 2008, they were all the way down to zero. A full, really, year ahead of when dividends got there, and this is an aggregate number for all banks of at least $5 billion in assets. But we can see, I know this is very hard to read, but this is the same picture only with lines instead of bars for individual banks, and you see much the same pattern. That's Bank of America, J.P. Morgan Chase, U.S. Bank Corp, even Wachovia before it was absorbed. So you see a pattern where pre-crisis the repurchases are quite variable, they fall sharply, and it's only some period of time later when dividends fall, the timing of that differs across banks. So what are the implications of the behavior of repurchases for the theories that I just talked about? If risk shifting were the dominant motivation, why do repurchases behave so differently? You could use repurchases to increase leverage relative to its potential if you kept those shares inside the company. Why do they fall so quickly? I'm going to argue that the behavior of repurchases is more consistent with concerns about signaling. There were concerns about losses in the economic environment, a lot of uncertainty, a desire to retain some capital in the firm. But and so repurchases, which are less transparent, less visible in the market, not really noted at the time that they are executed, were cut first as a way of kind of perhaps holding off having to cut the more publicly cut dividends. So that's the idea that I'm going to explore in the empirical work in this paper, to ask the question, what role did repurchases play in the timing and size of bank holding company dividend reductions during the crisis? Did the ability to reduce repurchases serve as a kind of buffer against the need and the timing of being able to cut dividends? Or alternatively, were somehow or other higher pre-crisis repurchases associated with the opposite effect for a variety of reasons? So banks that did a lot of repurchasing also paid a lot of dividends and needed to cut quicker. Banks that had more volatile income were the ones who did more repurchases, and therefore they had bigger losses sooner and had to cut dividends more quickly. And so those are some of the channels we're going to explore. The data sample, I wanted a set of relatively large bank holding companies, so they'd be all publicly traded. I looked at all bank holding companies with at least $5 billion in assets as of the beginning of 2005 that were paying a common stock dividend at the end of 2006. I had to focus on the dividend paying ones, which is almost all of them, because it's the question at hand is dividend reductions. Turned out there were 66 bank holding companies in the sample, and the data sources here are the Y9C reports, the regulatory report data for these companies. In the paper, I look at two distinct dividend events. The first is the first time there was a reduction in dividends during the financial crisis. And the second event is when or if a bank holding company got to basically zero dividends, either zero or a penny. All those results are in the paper. I'm just going to focus on the first of those today. And I should note I define financial crisis as the years 2007 to 2009. I partitioned the sample into smaller and large, they're all large to some extent, but smaller and larger bank holding companies, where larger is 25 billion and up in assets, and that's 24 of the 66 bank holding companies. And then I also partition into sort of high pre-crisis repurchase payers and low pre-crisis repurchase payers, simply by looking at the repurchases that were made in the 2 years prior to the financial crisis and taking banks that were above and below the median. So this just kind of is a quick run through some of the basic statistics. Of the 66 bank holding companies, 49 of them cut dividends during the crisis. That's about 3/4 of them. There's really not much differentiation in the bivariate results between the low repurchase and the high repurchase bank holding companies. However, if you look at the smaller bank holding companies, then there is, where the low repurchase bank holding companies were more likely to cut their dividends. There's less of that difference among the larger, basically because all but one of them cut their dividends during the crisis. The more formal empirical analysis of this, we use a proportional hazards model on the timing of dividend reductions during the financial crisis. There are sort of a parsimonious set of control variables on asset size, and these are all lagged, return on assets, the non-performing loan ratio. And then I look, clearly the capital ratio is an important variable here. So I look at a range of capital ratios based on both market value of equity and book values of equity, risk-based ratios, that is with risk-weighted assets in the denominator, and leverage type ratios with some form of just plain assets in the denominator. And I allow, based on the bivariate results I just showed you, I allow the coefficient on sort of the pre-crisis repurchase variable to vary by the size of the bank holding company. So this is the results. You can't read them all, but this is the coefficient on the variable that captures the extent of pre-crisis repurchases for the smaller bank holding companies. The different columns are, you can see at the bottom here, are different capital ratio measures. And basically, the bottom line here is that higher pre-crisis repurchases were, so this is a hazard model, so the negative coefficient is the shifter. It's a lower hazard in any particular quarter over the horizon. So the higher pre-crisis repurchases are associated with a lower probability or a later probability of cutting dividends for the smaller bank holding companies. However, for the larger bank holding companies, the opposite is true. It's a positive coefficient. Those who paid more dividend, did more repurchases prior to the crisis, tended to cut their dividends during the crisis more quickly. So it just repeats what I just said. The question is why? And then we'll look at a couple different explanations for why. The first is maybe it has something to do with who were the bank holding companies that tended to make higher repurchases before the crisis. It could be that those with more volatile income were also the ones who tended to do more repurchases. There's literature that shows that that volatility of income and choosing to do more repurchases, kind of, as opposed to dividends, kind of go together. I did a variety of tests in the paper to look at this, but here's the one I want to present to you. What I did was I actually put in a perfect foresight measure. This was ROA during the crisis, what actually happened to them. You can see for both the larger and smaller bank holding companies, higher ROA was lower probability or later cutting of dividends, which is what you would expect. But here for the larger bank holding companies, it really doesn't change the core result. A little less significant in some cases, but basically the coefficient is still positive. So it doesn't seem like those results are fully consistent with that channel. Another possible channel is somehow or other that the bank holding companies that did more repurchases got more, they were just more active in the market, they got more market scrutiny, therefore some form of more market discipline, and as a result they cut sooner. So here's a version where I put in as a measure of market scrutiny the number of analysts covering the banks. Again, you can see that these come in not always significantly, but with positive coefficients. The more analysts covering a bank holding company, the quicker they cut their dividends during the crisis. Yet if we look at the coefficient for the large banks on the repurchases, it's still positive and significant. So that doesn't seem to be the dominant channel. The final one I look at is maybe it's just somehow that the ones that did more repurchases had larger payouts overall. And here, this is not all the results, but this is where, in addition to the repurchases, I'm putting dividends before the crisis. And this maybe seems to have a little bit of action to it in that all of these coefficients are positive and significant. And in fact, if I add them together, so it's a little bit unfair just because this result wasn't in the paper. So, if I add them together and say just were total payouts before the crisis, that seems to be what's, perhaps what's driving the results. It's positive and significant. The ones that paid out more before the crisis tended to cut their dividends more quickly during the crisis. So, in summary, did I not even get to 5 minutes left? Wow. Talk really, really fast. So large bank holding companies did not reduce dividends until late in the financial crisis, but reduced their repurchases very early. Doesn't seem fully consistent with some of the risk-shifting explanations that have been put forward to explain dividend behavior, perhaps more consistent with concerns about market signaling, and it seems like their repurchase activity was related in some way to their dividend behavior, although differently for the smaller and the larger bank holding companies. Thank you.
And the discussant is this time Fang.
And good afternoon. I just want to follow all the presenters and the discussant and for their show their appreciation to our affiliate colleagues and especially Jalapa, and also about the disclaimers. And what I want to see is me too. So, this is a very interesting paper. I have a great interest in to read it. And then, so when I started reading this paper, I said, okay, let's do some research. And of course, the first thing is to go to the internet, right? Try to research the relevant topic. And suddenly I find there's a cartoon in The Economist. And in that paper, it discussed about the repurchase and the dividends. I said, oh, okay, maybe in The Economist, when we see this cartoon, we know we're talking about the repurchase and the dividend. So, and at least that's how I got the impression. So I think that's exactly is about the Beverly's paper. And actually, as how interesting is this one is when I just reviewed the paper, and actually in March, the board published the stress testing results for the C cars. And literally the next day, I saw the news in the market and make announcement about the buyback. I said, okay. I just put down some of the bullet points, right? So the next day after the Fed announced the stress testing results, and then they found out the Bank of America announced a $4 billion stock buyback plan, and the Citigroup announced the intention to buy back as much as the 7.8 billion of the stocks. And then JP also make an announcement about buyback of 6.4 billion, and Morgan Stanley 3.1 billion, right? And then so this is already together exceeds the 20 billions. So this is how interesting about this paper, and the topic is definitely on time. And also I find the quote from, you see, reading something from the Warren Buffett, and I just also want to share with you about this one because that's his view. He said that when the companies with outstanding business and the comfortable financial positions find their shares selling far below their intrinsic values in the marketplace, so no alternative actions can benefit the shareholders as shortly as repurchase. That's his view. So I just want to put this quote to share with you. And And also, I would lay out several bullet points about the roles, or what's the role the repurchase plays. And so, C as the temporary tools to absorb unexpected dispersion. And the second bullet is as the buffer to make the dividends less volatile. I think this actually is one of the hypotheses that Beverly tried to explore in this paper, and also as a cushion to reduce the future income volatility, and the tools to managing the cash, and also from a strategic point of view, and for the manager's strategic point of view, I think is of course as a conceptual belief that undervalued the share price, and also is as a strategy to boost the perception of the firm's value, and also is perception of it being good for the company, and also as a compensation tool for employee stock option rewarding. So this is I just want to list it here, and perhaps there's a couple of bullet points I want to come back if I have enough time. So Beverly already mentioned the hypothesis is a very interesting. It's really, right, the first hypothesis is about the timing, right? So for the banking holding companies with a higher pre-crisis repurchase, it's a really either delay the reduction of the dividends or delay the elimination of the dividend in the financial crisis. And the second hypothesis is really about amount. If you see, like for instance, if they are already decided to reduce the dividend, and then actually is for those bank holding companies, if they with a higher pre-crisis repurchase, they will reduce dividend likely, in other words, in a smaller scale. So this is a hypothesis Beverly tried to address in her paper. That's just a different way to talk about. So talk about the finding. It's very interesting. So I want to spend some time here about the finding. Let's move. First one is to talk about smaller bank holding companies. As Beverly mentioned, looks like this results makes sense, or at least based on our understanding, right? So for the smaller bank holding companies, I think, and so with a higher crisis purchase, reduce the dividend more slowly, right? And then you see, compare with the similar bank holding companies with the lower repurchase. So I think that's how exactly that's why take the repurchase as a cushion, right, for the dividend payments. So I think this is results is consistent with our understanding, and also another key result is for the smaller bank holding companies, if the pre-crisis repurchase impact the timing and the magnitude of a dividend, it is, you see, really is lesser, right? They found that as a relationship, I think can follow, and also is consistent with the other. Oh, only have 1 minute left? Oh my goodness. Okay, so, but however, when we move to the large banking, and really the results that you see, that's how Beverly mentioned, is looks like the results is if you have a higher pre-crisis repurchase, actually they accelerate the dividend reduction. And also is for, like for instance, for amount, they didn't see no relationship. It's a very puzzles me, really, really puzzled me as to why, what's happened. I think that's how my suggestion for Beverly is, right, because with this, and then so looks like that's against a lot of the common understanding. Just I think so. This paper explain the what piece, right? Because based on the data, everything. But I want her to explain why Why does it happen? Because it looks like against the right, because we said is take the repurchase as a buffer, looks like this is not buffer. And then for the larger holding company, we're thinking is, right, that's how the claim for the large company, they have multiple business lines, they have more, you see, products, so they didn't have a industry concentration, products concentration, looks like they are more resistant to the profit, the income. Somehow, you see, this is a very puzzle. Looks like the finding is not to support our common understanding. Must be there some reason to explain. So this is what my recommendation, like for instance, or how about the provisions, right? We know the provisions have, you see, normally lag, especially during the prior the financial crisis, and the bank reduced the provision to a very, very small amount, right? But so because of that, when we go to the, you see, financial crisis and the sudden losses amounted, bank didn't expect that loss. There's a many reasons. I don't know. We should think. I expect Beverly think about that. So because of timing issue, I cannot go through all this. Oh, too much. And so that's why another recommendation is, I know if she really face the data issue because only have 66 bank holding companies that have a dividend reduction. But I think that the definition is also I recommended because she defined a large bank is 25 billion above. But I think that looks like is inconsistent for our understanding, right? We have 215 the large GC banks or the large banks or regional banks, small banks, the definition 50 to 25 billion, or if possible, maybe just explore, I'm not sure the data is, can allow her to do that. That's my recommendation. Thank you.
We have time for some questions, and if we could pick up a few minutes, I'd like to come back and take questions on Kris's paper, which we did not have time for.
Question, comment for Kris. Kris, I believe this is the second time I've seen your presentation, and one thing that's caught my attention both times is I think it's very important for your audience that you differentiate between which restrictions are statutory versus what was voluntary on Ofeo's point. It doesn't come across in your presentation. Some things like a wind down scenario is statutory, and also the exact stress test, the 200 basis points movements in interest rates, and also finding, a particular experience for house prices was statutory. There was some discretion in figuring out that house price scenario, but a lot of it was statutory. So in terms of regulatory regimes, there's a lot on that side. And then in terms of the actual model specifications, I think that really speaks toward the AIRB framework today, because you're really more speaking to the large banks and how should regulators think about dealing with the banks and their own internal tests from this experience.
No, that's a good comment. So I think we do spell things out a little bit more clearly in the paper, where, but yeah, you're right. I should be a little bit more careful in the presentation.
Oh. The mic?
All right, there we go. In looking at the part of the shortfall, and that was due to the scenario, the what you call the mild house price scenario. I think you could. I don't know if you tried to further disaggregate that, but there's also the question of how to what extent was it assuming a constant house price decline across all regions or all cities versus allowing for the actual dispersion of house price decline, so that the decline in California, where a lot of the riskiest loans were located, were larger than, say, declines where some of the paper we heard before from Susan Wachter and her co-authors, that kind of interaction, as well as just the nonlinearity of the responsive default to house prices. would suggest, Jensen's inequality would suggest that you need to not assume a constant house price decline, so.
Yeah, so in the paper, we didn't experiment with different house price scenarios for different regions, but we did experiment in the model when you start to update the LTV ratios. We did some experimentation along the lines of, if you do use more disaggregated house price indices, like at the county level or the zip code level, to update those mark-to-market LTVs, to update the LTVs, that does make a difference actually. And that's in the paper. Yeah, I don't think we've really thought about the different, yeah. I mean, it's not clear. Do we do that? I don't.
That should get you this, if you update the LTVs at
Yeah,
the local level, that will get you.
Because
the
what's the
But
assumption?
I think the problem was that OFEO
What's the assumption with CCAR?
assumed a
though?
constant.
I mean, doesn't CCAR just apply the stress scenario to for mortgages the same in all regions? Isn't that the
No. Not the supervisory model does not.
I see. Okay, so there are different scenarios based on what the. Okay. Yeah, that's a good.
So you
that's a good
mentioned,
idea.
you mentioned the timing part where the delay, it might be interesting to separate out the parts of, there are three parts at least to the misspecification of the house price decline. One was the delay in the house price decline. Two was the depth, and three was assuming it
Was
constant.
assuming a constant, spatial,
So, Bev, let me ask you a question. You control for non-performing loans in your paper. Did you look at loan sales with recourse and the non-performance of the securities they sold to see whether, some of the largest institutions are doing most of them are doing a lot of this, and they may have had some sense at the point where you're finding the decline in their decline in dividends is early because of the growing non-performance of recourse sales.
The quick answer is no, I didn't look at that, but that's a good suggestion, so I will.
Leonard?
Mike, Leonard?
So you have a signaling model in mind. So have you looked at the signaling content of dividend reductions? So you have this great example of a whole series of dividend reductions. Those announcements, if there's signaling involved, you would think would have impacted things like bank risk or bank stock prices. Have you looked at that?
So I mean, again, the short answer is no. Other papers, mostly in the non-financial industry, but some in banking, have done things like that. Not necessarily during the financial crisis. I mean, I haven't done it. It is my impression that it's in some cases going to be hard to isolate the dividend reduction as an event because they would announce their dividend reductions on like earnings release days, and so you have a lot of information coming into the market. We lost so many billion, and oh, by the way, we're cutting our dividend, so it's hard. But that's certainly not true in every case, and that would be. I don't know if there's been a paper that's looked at the stock price reaction, to those dividend cuts during the crisis. It's a good idea.
Last question.
Also for Bev, do you know if the decision to cut dividends was, in all cases, voluntary, and if the banks were coerced into cutting their dividends, how would that affect your modeling?
I don't know. I mean, in this paper, it's strictly the fact of the dividend reduction. So I don't know whether it was voluntary, required under. I believe at the time, and I'm not a lawyer, but in the pre-capital plan rule world, the standard was safety and soundness to tell a bank it had to cut its dividends, and their capital ratios, the regulatory ratios, were for the most part pretty robust. Not all of them. So I don't know how many of them were. That doesn't mean there couldn't have been supervisory persuasion, behind the scenes. But it's a long way of saying I don't know. I don't control for that. I don't control for that. No, I don't know.
Thank you. The next paper is by Scott Smith on revisiting a counter-cyclical capital regime.
Thank you very much. I'd first like to acknowledge my co-authors, Deborah Fuller, Alex Bogan, Natalia Pokovnichenko, and Jesse Wire. And on behalf of all of us, I want to thank again the organizers of the conference and Paul and Jalapa in particular for all their help in getting everything organized and together. So with that, let me get started. The usual disclaimer applies. So this is the opinions of the authors and not that of FHFA. And as you see, based on the discussion we've just had about the old-fail model, a lot of what we're trying to do with this proposal is to address essentially all of the concerns that have been raised today so far about the old-fail model. Let's see. I don't really need to talk very much about credit models for mortgage assets. There seems to be a wide appreciation of them in the audience. I will mention that there's really two aspects to think about. One is the model itself, which is based on the borrower characteristics and loan-specific characteristics. And then there's the macro scenario. So our discussion today is really going to focus more on the macro scenario, although we will have something to say about model risk and using different credit risk models. Countercyclical capital is a idea that's been out there. It's built into the Dodd-Frank Act, actually, where the financial regulators are supposed to incorporate it into their regulations. For the most part, all that we've seen so far is a countercyclical capital buffer, and I'll talk a little bit about that and how our proposal differs from that. So what is a countercyclical capital regime? Well, I'm sort of going to start down in the outcome-related goals because that really gets to the essence of the countercyclical capital. The idea is that as the risks are increasing, as your housing price index is rising up well above trend, let's say, that's the point when you should be increasing capital requirements for new acquisitions as they come on board. And I'm talking about a firm that would be like Fannie, Freddie, any bank, any entity that wants to hold mortgage assets. This whole discussion is all about mortgage assets. As housing prices begin to fall, however, and the risk as to how far housing prices could fall in some future scenario seems to decline, well, then the capital requirement should be allowed to decline with it, again, for new acquisitions. So that's essentially what a countercyclical capital regime is all about, allowing the capital requirement to vary over the cycle, but in such a way as you're building up capital as you're in the expansion phase and you're allowing capital requirements to fall as you're in the decline. Another thing that I point out there is that we tried to set our regime up so that there would be full capitalization at acquisition. In other words, the capital you acquire on day one, when you acquire the assets on day one, that the capital requirement that comes out of the model should be sufficient to give you enough capital to fully capitalize those assets over the life of those assets. You should never have to go back into the market to raise more capital. So that was one of the goals of our design. The other part, and let me go back up to the top of the page now, the rules-based methodology. We wanted this to be rules-based. We did not want this to be discretionary. It's one of the big differences between the Basel-based countercyclical capital buffer, which is discretionary on the part of the regulators. That buffer is also capped at 2.5% of risk-based assets. In our regime, there's no cap, and it's not discretionary. It's deterministic based on the market fundamentals that are out there, and I'll explain exactly how we do that. And of course, ours is also dynamic. The stress that you're going to see with the shock varies over the cycle, so it's not the same stress depending on where you are. And then I'll point you to the very last line at the bottom. if you implement this regime as we've designed it, and if it were implemented broadly, meaning it applied to Fannie Freddie or, you know, a large proportion of the mortgage industry, then we think it would have the very positive effect of mitigating future house price bubbles. If it's just applied at the firm level, we think it'll go a long way to help protect that firm from insolvency should it have to suffer through another crisis like the last one we've seen. But it would be better to be applied broadly and again, have that positive effect on cycles. So how do we come up with this? Well, we're going to talk about a trend with housing prices. There is pretty much a consensus. There's a long-term trend that you see, and this is partly because there's such a long-term trend for GDP, and housing is a big component of GDP. So that seems to be observant. Even the people working on the Basel seem to come up with that concept. And so we're going to calculate a trend. We're also going to calculate a trough. The idea of the trough is that it's the lowest point that housing prices could fall. And we express it as a percentage of trend, and I'll explain how we get to that. And we'll skip over the 5% rule. That's sort of arbitrary. So here's a picture of real housing price index, and we do everything in real terms, and then we actually convert it to nominal because you have to run it through the credit risk models in nominal. But it's just easier to see what's going on and to calculate the stress initially in real terms. So here is the housing price index for California from 75 through 2013, and then we've calculated a trend line. The trend line is the solid red line in the middle, and then it turns to dotted lines afterwards. And that's because in calculating this trend line at the time that we did it, we cut it off at data through 2001 because the current cycle was deemed incomplete, and we didn't want to include an incomplete cycle. It would bias the trend line. And then below that is a dashed red line. That's our trough line. And we actually had a very simplistic approach to coming up with a trough, and I'll come back and defend it later. But the simplistic approach was to look at the lowest that housing prices had been for a given state. We do all this at the state level, so this addresses one of Paul's comments about the last issue. We look at the lowest that housing prices had been relative to trend at that state, and we use that to sort of establish the trough. Of course, if you went through a new cycle, and there could be a new lower trough, and we would then readjust the trough going forward to the new lower one. You might see to the left, it actually, there's a corner solution there, which we ignore. That's because the data out there is the weakest, and we just didn't feel like going with that. All right, and we'll come back to that trough discussion later. All right, the next thing we do is we calculate a shock time path, and there's a lot of discussion in here, but for the sake of time, I'm just going to jump to the picture. So the green line represents the shock time path. Based on our look of cycles over all 50 states and at least 2 series of cycles, we saw that a time path of 3 years down from wherever you are to the trough, 4 years of trough, and then 3 years back up to the long-term trend seemed to be about the average. This was fairly consistent. And so we imposed that time path. We'll talk later. What's most important about this time path is the time it takes from where you are to get down to the trough. So this is the shock to HPI that we would incorporate into the model. We also incorporate shocks to interest rate and to unemployment. Some models use unemployment, some don't. And we base the shocks to interest rates and unemployment on the sort of pattern that the Fed went through in adjusting interest rates during the most recent crisis. So this is what the shock would be for 2003. And then here we show it for 2003 and 2005. And so you can see how when we move to 2005, the severity of the shock, the depth to which you're going to allow housing prices to fall, actually increases, even though it's going down to the same trough. So here's where you're starting to see the dynamic nature of the stress test. So loans acquired in 2003 would have been subject to, I'm just making up the numbers here, like a 15% down shock, and the loans in 2005 would have been closer to a 30% down shock in HPI. Now the loans in 2003 would also be subject to, I mean, in 2005, the loans that you acquired in 2003, you could rerun through the model. But it's not going to be more severe on those loans in 2005, the 2003 loans in 2005, because they've had appreciation, and then essentially you're taking that appreciation away by the higher severity of the path. And this is what's going to lead to the design of this stress test having full capitalization and acquisition, so that the 2003 loans, when you subjected them to the stress there, they're going to have, that's the worst that can happen to 2003 loans. In 2005, they've appreciated, and you've increased the stress essentially to cancel that, but they've also aged. And so ultimately, the stress on them is going to be less. This just is a slide trying to explain that, but I've already done it, so I'll move on. All right, so one of the things that we wanted to do is to see whether our countercyclical stress path would have the same sort of consequences in terms of capital requirements over different years if we ran it through different credit risk models. So this gets at the issue of credit or model risk that was brought up earlier in the conference. And so we had two versions of an FHFA model that are just internal. The V1's the old model, V2's the new, better model, supposedly. We also had permission to use Black Knight and the ADCO model to run things through. So here's the result that we get. So that these are percentages, which are essentially capital requirements for a pool of 30-year fixed rate loans that Fannie Mae had. It's a very representative pool. And we drew separate, you have no choice, but you have to draw separate samples in each of the years, 2003, 5, 6, and you can see all the years that we do there. And one of the things that we're looking for in this pattern of capital requirements is the down diagonal here, having a pattern where the capital requirements would be increasing as we go from, say, 2003 to 2007. And you can see that, in fact, they increase rather dramatically. And then they start to fall as you go from 2007 to 2010. So the down diagonal represents the capital requirements on the new acquisitions that you'd be taking in, or the originations in that year. And so the pattern that comes out is exactly the countercyclical pattern that we would be looking for. Going to the next slide, we see going across a row, this shows you how the capital requirement for the loans acquired in 2003 changes over time as you rerun them through the model. And you can see that the requirement goes down every single year until we get to 2010. And we have an anomaly going on in 2010, and the reason for that is that by the time we get to 2010, so many of the good loans have prepaid, and what you have left is all the bad loans. And so percentage-wise, it looks like a higher capital requirement, but we'll show in a minute that dollar-wise, it's actually not. So the full capitalization at acquisition proposition is still holding. When we ran this across all four models, and I just showed you the results for one model, in the deck, I think I've got all four models, but when you run this across all four models, you can see the pattern of results. If you just look at the 2005 column, you'll see that V1 was almost 10%, V2 almost half of that. Black Knight came in at 6, and oops, I did something I didn't mean to do. There we go. And the ADCO came in also close to 10%. So there's almost a 2-to-1 difference depending on which credit model you run it through. And this is controlling for the macroeconomic scenario. And I can assure you from other work that we've done that if you alter the macroeconomic scenario, you can change that from 2-to-1 to almost 4-to-1. Now, over time, we expect credit risk models to get better. There's new data out there that will help bring some more consistency there, but you can get very different results. The one thing that does hold is that the countercyclical pattern holds no matter which credit risk model you run it through. So the stress test is dominant in making sure that pattern comes out. Our recommendation is don't rely on any one credit risk model, unless it's ADCO, and Andy paid me to say that. I know, I still have money. Joke, just a joke. All right, so I'm skipping ahead. This is showing the capital requirement normalized to 100 in the year of acquisition, and then how it would change over time with all four models. if you were to rerun the model. So again, the full capitalization, it starts at 100, it never goes back up to 100. So you should be fine. There are a little bit of concerns on some of this, and for that we recommend that you would never release more than 50% of what the model says you can release. If you did that, you'd clearly be safe. I'm skipping through here. Oh, we did a back test. So basically we went back and we said, well, what if we ran, what if in 2008 Fannie Mae had been subject to the countercyclical capital requirement? What would their capital requirement have been? And so taking the most or the least conservative model, the one with the lowest capital requirement, applying it to their book, we come out with a capital requirement of 138.7. Well, how much losses did they suffer? The answer is 122 billion. This is a different number than what Kris has, but there's reasons for that we could get together and explain, but I don't have time right now. Anyway, so we know that the model works. It's pretty well calibrated. In fact, if anything, it leans to conservative. I'm racing ahead. We did some testing of this trough. Remember I talked about the trough? And we looked at how the trough actually worked through the most recent cycle. And this is what we call the yellow bar chart. The bars that are positive, that are poking up, is where the actual trough was less. No, I'm sorry. The actual trough was, yes, less than what our model would have predicted. So that's where we would have overestimated capital. It's only the few bars on the left where we would have underestimated capital. So for the most part, it works. This is a chart where the red lines show how far down below trend the housing prices went, and the blue is how high above. You can see how asymmetric the cycles tend to be. This is a chart that shows 3 different housing price cycles. They are very similar, even though they're very different very similar in terms of the depth below trend. They're very similar, very different, I'm sorry, in terms of time above. I know I'm pressing here to get this done. One of the things that we've done, this is research that's not out yet, but hopefully in a few weeks it will be, is we've come up with a model to actually estimate what the trough should be. This model takes into account the investors' incentives, it takes into account variance in housing prices, and so forth. And this is where we've applied it actually to the state of Nevada. The red dashed line is the trough that we estimated with our old methodology. The blue line is with the new one. You can see how the new one does a much better job. So we're hopeful that we've sort of resolved some of the issues we had with our old crude methodology. We did some looking at the trend lines to see if you were to update the trend lines to include data through 2013, would it have made much difference? And the answer is no. Short answer is no. And there's some explanation in the paper as to why. And we've looked, and I just got the gong. I was just going to say, we looked at the 343 time path. And again, it's all about how quickly you get down to the trough that affects the severity. The more quickly you get down, the more severe the capital requirement is. And that's it. I'll stop right there. I just want to mention one last thing. On this last slide, you'll see a web address up there. If anyone is interested in actually looking at the countercyclical scenarios, we publish them quarterly now on a website, and you can download them and run them through your model and have a good time with it, as we do. Thank you very much.
The discussant for Scott's paper is Larry Wall. Thank you.
So while it's getting set up, I too will thank the organizers for inviting me. It's been an interesting conference.
Back and forth, and there's a laser point.
Okay. And I will also say the disclaimer, and if you didn't hear it from anybody who works for a government agency, they meant to say it, possibly excepting Loretta. No, but you did say it. You did say it. That's right. So this is an extension of a previous paper that proposed a method for setting countercyclical capital requirements for mortgages, where the credit losses would depend upon changes in the HPI, which are assumed to increase over the long run. HPI is assumed to increase in the long run at a constant trend, and the capital requirements should reflect the extent to which the current level of HPI is above this trend. And that was proposed in the prior paper. This paper had some robustness tests, looking at different prepayment and credit risk models, which show similar time trends, but produce some big differences in required capital. The paper's methodology would have required Fannie Mae to hold sufficient capital to maintain positive amounts through the crisis, and they find that the HPI models work reasonably well at the state level. And as was pointed out earlier, the least conservative version would have required almost 3 times the requirement, 138 billion, whereas Fannie at the end of 2007, which I think is about its peak for book capital, was about 47 billion. So again, we're talking about almost tripling capital requirements had they gone ahead and acquired the book of business that they didn't indeed acquire. So I like this general idea. I like the idea that we know we can have time varying requirements based on how the housing market has evolved. But I want to kind of push on a few dimensions. And so there's 2 main parts to the paper to me. One showing that Fannie Mae would have survived the crisis had the capital requirements been based on this, and another part showing that the earlier approach provides a good approximation of the potential decline in HPI and the time path of the decline and recovery. And so I want to comment on these, starting first with the estimate of Fannie Mae's required capital. Would better HPI assumptions by themselves have saved Fannie for a reasonable set of loss models? If yes, that provides pretty strong support. If we'd have known that this was the right way to view HPI possible declines at the time and just used this, that would have been really powerful information. But it's for a true back test, you can't use post information, and they use information that's available during the crisis, only comes available during the crisis. All 4 models use post-crisis data, and some of the inputs, as was explained earlier by Scott, come from post-crisis. So how much of the better estimates are due to a better HPI scenario, how much to better loss modeling, and how much to better knowledge of how unemployment and interest rates would move during the crisis? So the alternatives that I would recommend, kind of one approach is go back and run a true back test. You're not going to probably be able to do that with Black Knight or ADCO, but maybe if with V1 and V2, of course you then have to grow back and use the macro models that were available at that time. And having seen the results of some of those macro models, I can tell you, you would not have gotten what actually happened. We had more than a few discussions about that at our bank. The other possibility, and I talked a little bit with Scott about this one, is run a sensitivity test of the effect of the different assumptions about the possible trough in HPI given the current models and inputs based on the crisis. So basically, okay, we accept that we're going to use current models, we're going to use what we know happened during the trough, but let's just see how big the HPI assumptions, how much of the results that's driving. And there's various possibilities here. So then on the HPI scenario, it really involves 3 critical parts. How are we going to determine the trend? What's going to be the depth of the trough? And what's going to be the time pattern of the trough? And I have some suggestions on each. First of all, in the trend analysis, and this is really a critical piece of it, why should we expect to see a trend in the data? The paper argues the intuition behind Smith and Weir approach is that HPI has a long-term trend and that it is mean reverting. The stability of GDP growth over time and the fact that housing is a large component of GDP lend support to this intuition. Yeah, but HPI is at the local level, which is what the paper is focusing on what matters for default, and that's less stable than national GDP. Though, to the extent that, as the paper talks about, you've got a nationally diversified portfolio and you overestimate some, underestimate others, that partially offsets. But I still think you want to think a bit harder about defending this particular assumption. And the desired fraction of income and wealth devoted to housing can also vary through time. So some evidence of paper provided on the stability of mortgage service to income or housing wealth to total wealth ratios might be one way of getting at that part of the link. And I think it also matters kind of for the trend analysis, where are we in the housing cycle? And I'll skip on because I think I'm going to run out of time. So second question is the depth of the trough? Yes. The predicted troughs were based on the 1975 to 2001 data. It slightly overpredicted the national trough point, which is this little blue dot right there, just above the zero line. The paper, as I just pointed out, argues for a diversification benefit. But the empirical question is the trough related to the magnitude of the increase in the above trend values? And it looks like they're already working pretty far along on doing something about the depth of the trough. And then the last issue is this time path. The paper does a nice job of showing the length of the decline and the time at the depressed value, and the time to return to trend. All of these influence the expected losses. But the difference between the minimum and maximum using ADCO was 8.8% for the 3-year decline, 4-year at the bottom, and 3-year up pattern versus 6.64 for the 4.22 pattern. The conclusion is that the original paper's assumption was not unreasonable, if anything, proved conservative. But if I'm arguing for lower capital requirements, I'm going to push on every dimension that I possibly can. So some empirical questions here. Is that time path related to the extent to which prices increased above trend, to the total magnitude of the price decline, and or to the extent to which prices fell below the trend? Are some things that you could do to perhaps firm that up a bit. But overall, like I said, I very much like the idea of this paper and wish them luck with it. Thank you.
Thank you, Larry. Let's see if there are questions. Yes.
I didn't really understand in your approach the extent to which the historical home price experience in one state informs your trough that you would apply to another state. But if it doesn't, so that each state is separate, I guess I don't understand the motivation for treating them that way. I mean, instead of treating each state as unique and using troughs in a particular state as kind of, trough observations to inform the future of that state, why not look across states and, use the collection of state-by-state troughs to inform the model for all states?
Not really quite sure how to answer that other than to suggest that we do think housing prices are very much local. Even at the state level, we're actually engaged in a paper to try to look at them down at the MSA level and see whether that holds up. The more disaggregated you go, the more iffy the data becomes, and so there's a trade-off there at some point. But we think that, what's going on in Kansas is very different than what's going on in California, and I'm not really sure that anything that's going on in Kansas is informing what's going on in California. Yes.
My question really is for both Scott and for Kris here in terms of being careful of defining success and failure. And it seemed when you talk about it's okay because it's conservative, Scott, that concerns me because capital is expensive. And as we've learned the last number of years, when you tighten up on the banks, then capital is fungible, it goes other places. And also to the extent to which regime ends up in overcapitalization in more than half the states. And obviously you're going to restrict credit flows, restrict economic growth. So there are trade-offs involved. The tighter the regulation, the tighter credit facilities and less economic growth. And so I think it's the whole question of what is success and failure of a regulatory regime and what economic conditions should we protect against. One thing I think we learned during this last recession, nothing else, is there is only a federal government backstop. And so the question is, where should that backstop be? And so, Kris, and particularly for your work here, my question is, success and failure line can be three different places. I mean, is it the functional stress test as a failure? Is it the regulatory regime? Or was it the GSE facade, where Congress could say, we don't have any risk here, but nobody believed them?
Good questions. I mean, I don't, I think any objective person would have to conclude, though, that the AFEO experience was a failure. I mean, in the sense that even in the midst of the crisis, you had a stress test that was telling you that you were solvent when you were insolvent. So, I mean, I'll push back on that matter. Now we can, certainly they're important. It's an important debate to have about, do we really want to design these things to withstand, a Six Sigma event? But probably not, right? That's going to be really costly to society, but that's above my pay grade, so I don't.
I'd like to address that. When I talked about it being conservative, it's not that much conservative. In other words, the whole goal of what we were trying to do is to improve upon some sort of static stress test that wasn't taking into account market conditions at all. So, for example,
The CCAR.
There you go. May I? Well, now I'm going to get doubled.
The current CCAR, did the Federal Reserve turn that off when I mentioned the CCAR? The current CCAR housing price shock is in the neighborhood of, 29% down real, something like that. Our current countercyclical shock is about 15. So if you want to have a more accurate measure of capital, this will get you closer. We would still prefer to make sure that with a realistic scenario, you don't run out of capital and you don't fail. So if we're going to have a bias, it's got to be on the conservative side. But we really are trying to target it to be as close as possible to what we think is plausible.
Other questions? Well, if not, Ken, is there somebody, did I miss somebody? There.
Yeah, I'm trying to grapple with this concept that you've got a counter-cyclical capital regime when you've got a $138 billion capital charge on Fannie Mae in 2008. That just doesn't jive with a counter-cyclical capital plan.
Well, let me explain. First of all, as the capital requirements were going up between 2003 to 2005, the percentage capital requirement would have been so high early enough that Fannie Mae would have been discouraged from taking on a lot of the loans that ultimately were the problem and that failed. And so part of the goal here is to mitigate the cycle, and you do that by increasing the cost of taking the capital, of taking those loans on to where they would have slowed down. They would have had no choice because they couldn't have raised that much capital in that short a time.
Okay, well, Ken and Paul are going to have the last word in just a minute. But before they do, I thought it would be appropriate for all of us to thank Ken, Paul, Jalapa, and Bill, and everyone else here involved in organizing and putting on this conference. Say thank you.
Have a brief last word, second to last word. I don't know, can do the last word, but so the organizers got thanked a lot. So I really think we really should especially thank the presenters and discussants. I think they did a phenomenal job. Really excellent presentations and discussions, well prepared. So lots of thanks to them. Thanks to Ken and Temple University, Fox School, and Journal of Economics and Business for co-sponsoring this. So let me briefly re-emphasize the reason for the conference is that at least from the Federal Reserve Bank's point of view, we place a very high priority on facilitating, promoting communication on issues related to regulation of consumer credit, especially this particular bank. Obviously, the system as a whole wants to promote research on all sorts of economic issues, but the Philadelphia is focused on consumer credit, and we really want to promote the discussions and the research. And this particular conference was sponsored by the Supervision Regulation Credit Department, but that objective is shared across the Reserve Bank, and it's also supported by the Research Department, the Community Development Area, and our Payment Card Center. Obviously, the sharing of ideas, helps generate good feedback for the researchers and generates new research ideas, and maybe hopefully also provides at some point constructive impact on policymaking. I hope that when you leave, you continue to share your research with us at Philadelphia. Send us your new papers. I'm sure there are others in the audience would also appreciate receiving, your future research, whether new versions of the papers presented here or new papers. So continue with that sharing, and thanks for coming, and have a safe trip home.
Well, unlike Larry, I don't have to say it. Many years ago, I was member of the Federal Reserve Board in Washington, but no longer, so I don't have to say it. But I am going to say two general comments, one for the whole conference itself, and the other for the authors of papers that will go into the special issue. At lunch today, the group started to talk, and we just asked ourselves, why is this such an interesting conference? Looked around, there were 4 of us. 3 of us had gray hairs, and 1 of us didn't, so maybe the gray hair was part of it. Gray-haired people tend to be nice and pleasant, etc. And that makes for a pleasant conference in general. Then we began to explore in more detail some of the reasons why, and we all agree that the papers are very interesting. I mean, this subject is fascinating. The presenters, excellent. I mean, it was easy to follow almost everyone that was presenting, even when I was a little bit sleepy in the back there from time to time. But honestly, I think what made this a really outstanding conference were the discussants. They were on the money almost every single time. In fact, I would say every single time. As an editor of a journal, and I've been editor for many, many years, I've probably read a couple thousand, 4,000, 5,000 referee reports. And generally, they divide into two different groups. The incredibly negative report, I hate this paper, I don't ever want to see it again, et cetera, et cetera. And the positive reports, which almost every single discussion was like that. Incredibly positive, insightful comments. So even if your paper is not going to go into the special issue, and about 50% of them will, I urge you to read those discussants. It's like getting a free referee report. And ultimately, as an editor, I know how important it is to take a positive referee report and to really work with it and change your paper accordingly. And almost always, when it goes back to that referee, you got a 95% probability. So that's the general comment. More specific to the authors, I talked last night to Elsevier, which is the publisher of the Journal of Economics and Business, and I asked them to give me a targeted date at which the special issue would be published, and their preference is to publish it as the first issue of 2016. So it looks as though we have a lot of time, but let me knock off a couple of months here. In order to do that, they need galleys by November the 15th. So that gives us about 6.5 months to get everything to them. If this were an academic audience primarily, and it's not, it's the audience that has to say it. If this were an academic audience, that would be easy because you'd have the whole summertime. But this is basically a Federal Reserve System audience, and so you're gonna have vacations in the summer. And that's gonna be a little downtime for you guys, obviously. I will be sending you what I like to think of as love notes. Don't take them personal. It's just an attempt on my part to keep you on track so that your paper is going to be in there for the special issue that hopefully will come out as the first issue of next year. If you run into problems, and this can happen either because some important policy memo you need to write emerges in the middle of the summer and you just don't have any time, just let us know. Send me an email or Jalapa. We'll try to work with you to see if we can move the timing of the special issue in a slightly different way so that we will make every effort to incorporate your paper into the special issue. So finally, I want to thank Paul and Bill and Julapa for their inviting of the Journal of Economics and Business to this conference. But especially, I want to thank Jalapa. Honestly, I did about this much. She did about this much. Without her, there ain't no conference, folks. So thank you, Jalapa. I really appreciate it. Thank everybody. Have a safe trip home.